All right, everyone, thank you for joining us today. I'm here with James Check, the world's greatest on-chain analyst when it comes to Bitcoin. And I thought, in light of current market conditions, it would be great to hear from the best in the business as to what's happening. Is the sky falling in? Is it all over for Bitcoin? Or is there a little bit of silver lining in this cloud that we're running through at the moment? So I think to kick things off, James, I think we should have a chat about what the last couple of months has looked like for us in the industry. And I might get your take on things to start with.
Yeah, for sure. So thanks for having me on. And again, this is one of those interesting developments where the last 2 weeks specifically, it's been fairly quiet. We've got two kind of main sources of information in terms of just clients and people flowing in. We've also got our subscriber base. Now, short story, since November, it's been our softest patch, but we're not losing people. So we've got a lot of really, if you think about what our overall subscriber count looks like, it actually looks like the ETF chart. You get a big burst of things when markets go up or down. Volatility creates that uncertainty. And then when it goes nowhere, people start to drop off. And then the market moves again. So we've just bottomed again and we're starting to move higher again because now there's volatility. People are going, hang on a second, what's going on? And it really comes back to our core business model. Uncertainty is what people are trying to minimize. So what I love about Bitcoin is we can look at data across futures, options, ETFs, on-chain, and it actually helps us just visualize what's going on. So for me, my general inbox in the last 2 weeks just lit off. The moment we lost 80K for that second time, and we'll talk through in some of the charts later on why that is, because a very important psychological reason. When you see it, it will make sense, but my inbox lit up. I went onto Twitter. I had 10 requests for podcasts, right? It's been quiet for 3 months. Every man and his dog wants a podcast episode. Everyone's looking for, some kind of insight as to what's going on. And interestingly, we've kind of been watching the market since the all-time high, just slowly breaking through. I won't go into all the details, but 110 was a key level. Then 105 was the next one. We got past the halfway point where things started to get a bit hairy. Once you get to 100, I was saying we're very close. This is the last line of defense before the Bulls' last stand, which was 95. And I said, once you get to 95, we're probably going 80 because, you got to ask, why did you get pushed all the way back to your last line of defense? The Bulls are clearly on the back foot. And of course, we teleport to 80. And I think that took everyone by surprise. No one was really expecting it, probably because they had too much upside envy of what they thought could happen. And I think that move down to 80 was just a correction of everybody's expectations. This next move down is an important one. And again, we'll talk about why, and you can see it clear as day from the charts as to why this is the case. This is the point where everyone is now going through the whatever stage of grief it is where they're accepting that it's a bear market. This is now the acceptance phase of the bear. And I don't know where that actually sits in the sequence of grief, but we're in the second half. We're in the second half. Most of the hard stuff has been done. We're now just going through them, honestly, and I've been describing it recently as a herd of bison. Bison are one of the few animals that when the storm comes, they don't run away from it. They turn and they run straight through it. And the reason why is that there's a back end. They don't know how big the storm is. They just know that there is another side to it. And they just run through it because all the other animals get caught the whole way they're running away. They get wet the whole time. The bison go straight through, they get to the other side, and that's actually the fastest way through the storm. And that's what I think the right mindset is for people at this point in time.
It's funny you say that. I look at the market sentiment. We've had a similar type interest in what we do since the all-time highs. It's sort of been a declining scale over that period. And now, obviously, a lot of clients want to understand what's happening because of that fear. I think the sentiment that I'm seeing is as bad as I can remember. I've been here since 2016. I've watched the 2018 bear market. I've watched FTX blow up. I've experienced it all, but the sentiment I've never seen so low when we're at a price of circa 70,000. And it's funny seeing that. And I guess the question we get asked the most is, has the fundamental thesis around Bitcoin changed in light of this price action that we've seen?
Yes, and I'll bring up some charts now because I think this is where we can get into some of the meat of it. I would hazard a guess, and just before we jump into these charts, first thing that people should just always remember is that markets are psychological. It is a game of the world, it's the tide flowing in and out, and most of the feelings that you have is based on your expectations, and there's a few types of pain. There's drawdown pain, which is literally just price going down. There's time pain, which is not going anywhere and you're just getting bored. There's something we'll talk about first, which is parabola envy, everyone watching silver, and the amount, if you're a Bitcoiner out there who bought the gold top, that feeling of FOMO is the fourth kind of pain, and that's actually measurably the worst one. FOMO watching another asset go up that you wanted to own is actually much more psychologically painful than cutting a loss or like having to be patient and wait. FOMO is it's a drug, and people, they chase it and they do dumb decisions. Your emotional hardware kicks in and you make the wrong decision at the wrong time. And that's what I love about all this data is you can basically take a lot of the noise out of the mix to just understand why things happen. So let's just start with gold, because I think it is important to understand gold. It's part of the big picture macro story. As we know, Bitcoin is a macro grade asset. Let's not kid ourselves. We're in like the top 10 assets of multi-trillion-dollar in 16 years. It's like, this is just unheard of. So I think a lot of folks probably got a little bit too emboldened by the new administration being pro-Bitcoin and thought it's going to be the thing that people go to in a sovereign debt crisis. It might be, but not in round one. Gold as again, 5,000 years, 12 trillion, now 36 odd trillion. There was no other tool. There was no other asset that people can trust. Bitcoin will get there, but it's just going to take time. And ultimately, that is the concept. Like, we're not early in Bitcoin's life cycle, but we're also early in terms of like what it's realizing its potential. We've been forming a lot of those foundations. Gold's got that. I don't have to explain to my father what gold is. It took me time to explain what Bitcoin was. So that's just a part of the process. Now, I wanted to start here with this chart because obviously gold, this is the gold price in black going parabolic. And it's important to just remember that this, Peter Schiff, he didn't have gray hair waiting for the silver market to go up, right? He grew silver hair waiting for this to happen. This is a multi-decade long process that's really just coming out. It's like it has been brewing for a long time, and even gold's good run, it basically offsets what Bitcoin has done since 2022. And I use 2022 quite a lot when I talk about gold because that's when the US froze Russia's reserves. And that's pretty much this crossover here. So the chart we're looking at is US 10-year interest rates inverted. And there's been a very clear relationship for the longest time where if treasuries are yielding more, why would you own an inert, yellow, yieldless, archaic relic? But what we've seen is that gold has gone parabolic whilst rates are heading higher. This is an inverse correlation, and it broke in around February 2022 when the US froze Russia's reserves. Every sovereign in the world is realizing we have to diversify our assets. Now, there is a supply and demand balance for things like gold and silver that Bitcoin doesn't have. I mean, gold obviously has the central bank demand, which is massive. And also, it's just got that price history. It's got all the infrastructure in play. You don't have to debate what gold is. Most institutions still don't own gold, just the same way they don't own Bitcoin. Silver's got its own supply and demand deficit, which has been brewing for many, many years. So I think a lot of folks have parabola envy, but are probably missing just like in the big picture of things, gold's multi-decade brewing long move is kind of a typical good year for Bitcoin. And I think it's really important to remember that when a $36 trillion asset can go vertical like this, when liquidity really just hits one of these assets, and like I would just have in mind, unless you think like your decision tree is Bitcoin is either dead, in which case hang up the phone and that's probably the end of the podcast. If you don't think Bitcoin is dead, from that perspective, imagine what happens when the momentum kicks back in, because it will bottom out eventually. We'll find a floor. Once the thing starts moving, all those momentum traders that chase everything will come flying back in, and price has this beautiful way of just repairing any narrative you want. There's 1,001 narratives as to why Bitcoin's going to die, and there will be plenty of obituaries in the next couple of months, but as we know, Bitcoin is pretty resilient as a beast. Now, for those who do have precious metals envy, and I know a lot of folks, and I actually sold a third of my silver because I just looked at this overall setup, and this is an oscillator of gold price versus its 200-week moving average. We're getting up to levels that in the final blow-off top of 1979 is the only time we've been this stretched away from the 200-week. So there's really two takeaways. One, it is highly improbable that gold keeps going up the way it currently is. It needs to take a rest. No asset goes up vertically forever, because otherwise you end up at infinity, and that's just not a practical thing. So gold is most likely extremely overheated, silver even more so. Can they go higher? Yes, but it's not going to be it's going to be a quick trip. and then these markets have to consolidate and rest. So there is parabola envy, but also that capital is going to have to find somewhere else to go. I don't think I'm actually very constructive on gold and even silver to an extent, but in the immediate term, let that FOMO just go. I often feel when you've got that FOMO, go for a walk, because it is the kind of thing that you make dumb decisions that are emotionally driven. And just building on this is the monthly gold price, and it's exactly the same for silver, by the way. RSI of 95, completely and utterly off the charts in terms of relative strength. And this funky looking oscillator down the bottom here is actually a really important one. It was designed for commodities. It's called the choppiness index. The best way to think about it is like a fuel tank for a trend. Markets just don't go up or down in a straight line. They need rest and recuperation. Now, this is on the monthly time frame, and we're at a level that is considered to be exhausted. So that basically means that this move has been so linear in one direction that it now needs on the order of several months, 10 months, 12 months. In gold's case, sometimes it's 24 months of time to just rest and recuperate. So really, I think the big takeaway message that I've got from this, all assets, even the ones that rip, and gold's got a tremendous story for why it's going to do very well in the next decade. It is not going to price it all in a 2-year span. It's going to go through rest. It's going to go through breaks. Bitcoin is much the same story. 2023 and 24 were spectacular years. We did a 5x. We hit, top 6 assets in the world. The ETFs have gone live. The infrastructure that's been put in place is live. Bitcoin is in, I would argue, from a fundamental standpoint, the best position it's ever been in. And actually, Pete, I come back to a line that you said. Alec and I talk about this all the time at the Bitcoin Live conference. And I think the price would have been like 60K or 70K. And you were basically saying, like, at a $60,000, $70,000 Bitcoin, it is so de-risked that the upside is much more assured because you've got rid of all the risk of it going to zero. So yes, it's a more expensive asset, but the risk that it had to grow out of at $100, at $1,000, at $10,000, it's grown out of all of those growing pains. So I think that's a really important framework just to keep in mind as we move forward.
On that, the bottom indicator you've got there, you mentioned in the last week or so you sold some silver holdings. Was that one of the indicators that you used to come to that decision that this is absolutely exhausted, there's not a lot, it needs consolidation from here?
Yeah, so basically my thesis was silver and platinum, which again, these are small parts of my portfolio, but I sold a third of my silver, got about a 3x in it, and I'm completely out in terms of my cost basis. So it was a nice, just like even trade. It was always speculative, so the plan was to sell a chunk to, at minimum, get my initial investment back. I started seeing a lot of froth. I mean, if you're on Twitter or X, every community became a silver community. Everyone's talking about silver. It was the only thing you could see on the internet. So that was a sign of froth. These technicals, basically I said, it's just so, the price chart is vertical. And then it was actually the Friday before Australia Day. The price just absolutely mooned. And then over the weekend, I made the decision to sell. Now, I can't sell on Australia Day because the bullion deals are closed. So Monday was another big SLV, the ETF in the US, traded 36 billion in one day, more than the stock market did. SLV blew away the most traded thing on the market that day. And I was like, that is just, that's wrong. Things were getting volatile, things were getting choppy. I was like, it was bulletproof. I was counting out my coins and a couple of bars I was going to go and sell. And then I got a message from someone else who I know who's very in tune with markets. And he goes, completely out of the blue, my uranium conversation, the uranium, by the way, is doing very well. My uranium channel is turned into a silver community. I went and got another bar out because I'm like, that's just froth. And I've told this story before, but the line of people at the bullion dealer, I got there first and the line started to build up behind me. Again, a line at a bullion dealer. These folks were talking about the coins they bought 2 weeks ago and how they've already made X dollars. And, oh yeah, I've been telling all my friends, but they don't want to get in. They don't believe me. They don't get it. Look how happy I am now. Anyway, I'm in there selling the silver and they're counting out coins and whatever, reminding me again how of a physical pain in the ass process selling physical metal is. The lady next to me wanted to buy the shiniest of the coins. I was selling mine for about 150 Aussie. She was buying hers for about 220 Aussie. So there's your premium markup, and she didn't care. She was like, give me all of them. Make them shiny. I want to buy all of them. The next lady that came in after her didn't know what a troy ounce was. So we're talking about folks who have no clue what they're doing. I'm standing there selling, and there was one other bloke there, very clearly has been stacking silver for a long time, lifted up a mountain of a bag. You held it thud on the table. He's counting out bars. He's clearly been here for a while, knows what's up. So I just looked at that room and I thought, this is now speculatively silly. At a minimum, this is a good time to take money off the table.
So with that experience, you had to wait 24 hours. I'm curious if there was any slippage on the sale from what you expected to get and what the slippage was in the price that you thought you'd get and the price you were.
So the main, yes, there was. The main slippage actually was, so on the Monday, I would have loved to have sold on the Monday. Australia Day, bullion deals are closed. I would have loved to have sold on the Monday, couldn't. I'm waiting in line. So the actual dealer, very good. They gave me a 2% below spot. Happy to take that. 2% below spot's good. The challenge was in the morning. I've got my coffee. I'm standing there in the line. It's 8:45, and I'm watching the spot price. I lost $1,000 standing in line, just waiting for the shop to open. I can see them putting all the coins and stuff out for a display, and I lost $1,000 simply because I couldn't sell it then and there. And there's a ton of silver bugs who want to tell me, oh, that's, you did it wrong. You should have done this, that, and the other. I'm like, there are no bullion dealers open on a Monday. 9 a.m. Tuesday was the fastest, soonest I could have sold it. I could have gone onto eBay and taken a 13% price hit to sell it. I could have also just peeled off a chunk of Bitcoin. It's just this reminder of where the future is going. So let's transition to looking at Bitcoin. I want to look at this from a few different angles. First of all, to contextualize some things. Now, there's no question. First of all, we're in a bear market. I think it's pretty obvious that we're in a bear market. Sentiment generally in bear markets deteriorates. It eventually bottoms. We will get a capitulation at some point in time. As a bison, you just keep running through the storm and this thing will come out the other side. But what I think on-chain data, and we look at ETFs and everything, it gives us a really nice lens of what's everyone else doing? What are all the other players at the poker table? We can't see their cards, but we can see their emotions. We can see their actions. We can see the aggregate spread of what everyone is doing. So let's start with the ETFs. As I said, our subscriber numbers pretty much looks just like this chart. Very, maybe a little bit less bouncy. So this current event that we're seeing here, price is down 40% from the all-time high. By the way, this is the cumulative inflows, just running a cumulative sum on all the inflow and outflow dollars. So the best way to think about this is new capital that has come in and stayed in the ETFs. Hasn't sold out, purely inflows minus all the outflows. We're down about 12%. So price is down 40%, but the outflows are down about 12%. If you look at it in terms of AUM, right, not in US dollar terms, but in Bitcoin terms, because really that's showing you how much inventory has come in versus out. The overall AUM is only down 6%. So we're talking about a 40% drawdown, end of the world level sentiment, as bearish as you can possibly imagine it, 2022 level of bearishness. And yet the ETFs have seen 6% of the AUM flow out, 12% of the capital. And it's important to note when we look at the capital flows, we've seen about $7.5 billion come out since the all-time high. Meaningful number, very large number. But we've got to remember that about $55.6 billion still has flowed in on net. And that's coming down from a high of about $62 billion. So we've still got a very, very large sum that has gone in and stayed in the ETFs. But this is where it gets really interesting. The headlines you'll see on socials goes, oh no, 7 billion worth of ETF outflows. Green is ETF 30-day change, capital flowing in and out of the ETFs. The yellow is changes in the CME open interest in terms of how many positions are open. When they're matching each other, there is and by the way, this is coming into year end. What happens at the end of year end? Window dressing. It's companies that put a basis trade, they long the ETF, they short the future. How do they unwind that trade? They sell the ETF, they buy back the future. This is window dressing. So of that 7.5 billion of outflows, the lion's share of it is actually just structural market positioning stuff. This is not hodlers being like, get me out of this thing, Bitcoin's dead in the water. This is hedge funds putting on trades that they don't care what the price is. This could be actual corn rather than Bitcoin. So I would say that this current outflow right? Significantly small. Let me turn off the CME. This current outflow, this is actually people selling. And if you really put things into perspective, it's fairly small. So I'm actually of the view, and I've been calling them the extraordinary ETFs, because the narrative when they first came live is ETFs would just be like an orange poker chip. And, TradFi guys would just buy it for a bit of hot sauce in their portfolio. I never believed that as a story, but I thought there's got to be some of that. I don't believe that is a big part of any of it anymore. I actually think the ETFs are arguably better hodlers than most hodlers at this point. It's quite remarkable how much capital goes in and just stays there. It's quite a remarkable thing to watch. Most of the time we're seeing outflows, it's structural. So they seem to be very much a passive, and I can actually say that this is how I use it. I use some of the ETFs in my retirement account, my superannuation fund. I don't think about the price. I never think about the price because that's my longest duration asset. I just stack and let it do its thing. And I suspect there's a lot of people doing the same thing with these vehicles.
I think to put some flesh on that, that's probably an advisor type product as well, where insignificant amounts of asset allocation are afforded to the ETF. So whether it's 1 or 2% allocation to it, if it drops 40%, they don't care. They're holding for what you said, a long term. So it's an insignificant part of their portfolio. They'll probably be adding, and I think there's been some talk of that's now turning back the other way. We'll see some inflows from institutions and advised clients alike.
And that's it. And probably one more point to just raise is the ETFs, in terms of their flow patterns, what we've historically seen is two things. We get a period of outflows, and then we've had significantly larger inflows. The inflow period, like the average week inflow, is about 3 times larger than the average outflow week, and that's fairly typical. But what we generally see is, like all metrics, we see at the local lows, at global lows, we see the maximum amount of ETF outflows. So if you think about this from like a market sentiment perspective, when do people actually sell? And this is measurable on chain. It's measured in all markets. We just happen to see it. They sell the most when they're the most scared. And that is usually when they've been hodling. They've bought a bunch up here. They don't sell up here. They go, oh, but what if it comes back? Oh, but what if it comes back? But it might come back. Hang on, I found this new... Oh, no, it's over. And then they sell it all. And you get the biggest outflows, the scariest, angriest headlines at the exact time that it should actually be going in the other direction. And you should be looking for those opportunities. So, and we'll talk about where we are in this bear market. Can I just flag this blue line back here? Let me get rid of the flows for a second. We'll come back and there's another chart where I talk about this. This is the average ETF inflow cost basis, which is priced when they came in. Currently sitting about 82,500. Why did this sell off particularly light my phone up like crazy? Because we're now below the midpoint. We've just passed the midpoint of the market. There's an on-chain model that is exactly here at 80K as well. From an on-chain perspective, it's literally the statistical middle, the perfect mean reversion oscillator. Statistics are, we spend 50% of our time above it, 50% below it. The long-term average and median of how price cycles around it is like 1 and 1. We just crossed the midpoint. So if we kind of think about this, yes, there's probably some downside ahead of us, and we'll talk about what that looks like. But also, this is where for us as a business, we've broken 80K. We've just doubled our daily DCA. We turned it on at 95 at that bull's last stand because we think we're now in a value zone. Below 80, we're now getting into some real nice territory. Below 70, I'm of the view we're in deep value. And, you kind of flip the script and go, do I really care that I bought at 6K, 5K, 8K back in 2018? Not really. Or 2019? Do I care I bought it 22, 20, 15, 17, 18 in 2022? No, I don't. Kind of want to buy all of it. I just want to buy that whole basing pattern because we're in the second half. We're in the fun part if you've got the patience to survive the downside. And by the way, this is another... I think this is one of my favorite charts. It's a bit nuanced, but just to understand how big things are, just the size. And I want to put 2 headlines to rest. That Saylor is the only buyer of Bitcoin and that the ETFs are the only thing keeping us propped up. You've probably seen this 101 times. And also to explain why 2025 didn't go up as much as you expected. The orange line here is a derivative. It's basically a 30-day difference of what I think is the most important metric in Bitcoin, frankly, which is called the realized cap. The market cap looks at every coin in the supply multiplied by the current spot price. The realized cap values every coin when it last moved on chain. You buy a coin at 10K, you sell it at 100K, someone's got to come in at $90,000 of capital, Someone buys 100K, sells at 10K, they've destroyed 90 grand worth of capital. So it's showing you what is Bitcoin really worth in terms of how much people have saved in it. Now, this is the 30-day change of that metric, showing us capital inflows, which is balanced by profit taking. They're one and the same. The amount of profit taking that we saw since that April bottom, so here's the tariff tantrum bottom, tremendous, sustained. This is $64 billion a month, $30 billion a month, $35 billion a month. This is a tremendous amount of sell side. And you can see as it picks up, we just get the market slowly, it just can't grind through it. So a bit of profit taking is fine, but a lot of it oversaturates the market. This is the thing that a lot of people didn't see and talk about. On chain, we can see when old hands are starting to distribute. Why do they sell? Actually doesn't matter because they always sell when the market goes up. This is just how it's always behaved. The green line is the 30-day change of the ETFs. At best, they're 20% of the total sell side. So the ETFs are a meaningful but minority component of the market. And this purple line down the bottom here is Michael Saylor with strategy. So I know a lot of headlines like to say that strategy and the ETFs are the only thing keeping the Bitcoin market up, but they're only accounting for 20, 30% of the demand. They're kind of missing the remaining spot market that is much harder to measure and harder to see, but you can see it in the on-chain world. So yes, they're a key demand vector, but they are by no means the only demand vector that exists. Okay, so let's talk about long-term holders, because what I like about, when we look at on-chain data, we can look at two different groups, people who bought recently, people who've held for a long time. We're trying to get a read on all the other people at the poker table. Now, I mentioned before, long-term holders, which is this total supply curve, they sell in bulls. They always have. You can see in 2021, 2017, these big U-shaped dips show when long-term holders distribute coins and basically sell into strength. We had 1, 2, 3 waves of this. Now, this metric is a little bit interesting because when long-term holders sell, if you've held a coin for a year, when you sell it, it immediately is no longer 1 year old. But in order to get back into long-term holder status and prove that it's got that like opportunity cost, we use about a 5-month threshold. It takes 5 months for coins to mature into this age bracket. So when it stops going down, it tells you that they've stopped spending. We have that biggest headwind that stopped us in 2025 is falling off a cliff. And we're now moving back into a territory of hodling. Now, this is typical behavior for downturns, right? Bear markets are this process of long-term holder supply climbing, returning back to some kind of equilibrium, and then eventually we get an actual supply squeeze. We're in that process where the spending has stopped. So what's that sentiment signal? Folks who knew to sell the top are now no longer selling. They're now moving back into, I'm going to wait, and then eventually they're going to move into accumulation type mode. This is the total sell side coming from these guys off a cliff. The signal that this is sending is in my view, pretty crystal clear. 80K and below is simply no longer favorable for profit taking. They've moved at a minimum into the wait and see, and then they're going to move back into the accumulation period. We've always seen this play out. Now, the headwinds that we have to work through, this is just nice to visualize where we are in the structure. This is actually the Bitcoin supply weighted by when the price at last moved. So think about this as like, this is where everyone invested their capital. X-axis is price, and the height of the bars is how much value was invested at that cost basis. The blue zones are long-term holders. They're people who have shown that they kind of want to sit tight and hold. I've got some coins up here that are probably migrating to long-term holder status as we speak. And then short-term holders are in red. Now, where we are right now at 74, 75K, about 80% of the capital that flowed into Bitcoin is at higher prices. So there's a couple of things here. There are people in this bucket who are going to capitulate to lower prices. They may not know it yet, and they're probably hovering over the sell button, but they will. For me as an analyst, I'm waiting for that to happen. So I do not believe we've hit a bottom yet. However, we've got a lot of the ingredients in play where there's a lot of people who are now hovering over that red button being like, but what if it goes to zero? I think they've got that parabola envy from gold going up, and they're probably rotating out at the exact wrong time to be doing so. And we will see these capitulation signals. It only happens at bear market floors. We see at the absolute bottom, happened at FTX, COVID, the bottom of 2018. It only happens once in a cycle. You get short-term holders who take loss at massive scale. Normal. You have long-term holders. All these blue guys at the top here who bought the top price, they hodl through the whole bear, and the poor souls sell all at the same time at the bottom. And then you actually get another bucket. These guys down here. The people who actually are in profit, they take profit when we hit the bottom. It's this beautiful combination of everyone panics. And they all do it at the same time on the same day at the exact point in time when they should be reversing. Everything should be in reverse. They're succumbing to their emotions rather than making a logical, probabilistic-based assessment of what is likely to happen. They follow their gut instinct of saying, but I'm afraid that this is going to happen. It's a whole different ballpark. And as people in markets, we're constantly fighting this dynamic. And now we're getting towards the end here. I want to just show you why this cycle has a lot of things that are different. There are a lot of things that are similar. The overall structure of this market is actually relatively similar to a lot of previous bears. But the flip side of it is that the support that's below us is very, very different. The heat map that we're looking at is basically where long-term holder supply is concentrated. Think about it like the density of where people bought their coins and then hodled them for at least 6 months. You can see there's areas that turn dark blue and then they slowly fade over time as profit taking takes place. So people who bought down here, once the market hits their level, they actually sell up to higher levels. Now in 2021 and 2017, the market just ran so hard, so fast. We went from 10K to 69K in a matter of months. Now, as we know, we then had the rate hikes. FTX was a fraud. Genesis was a fraud. 3 Arrows was a fraud. Like a complete liquidation of the lending market. But on the way up, there was no buy-side support. It was never a journey or a process where people actually agreed on what Bitcoin was worth. On the way up, it was just a straight shot driven by, frankly, a lot of speculation, a lot of fast money capital, stimulus checks, all this sort of thing. And this has left what I call an air pocket, a supply air pocket. There is basically no support through that zone. And the 2022 bear market, with the aid of the biggest fraud in history at the time, I believe, maybe even still, we backfilled a very large chunk of it. Now, the equivalent air pocket that we have in our current market cycle is basically following the US election. And it goes from about 80K down to 70K, which in other words means we've more or less done the equivalent of this move. You can see there's a ton of support the whole way down. This 2024 chop solidation zone that we spent 8 months, there's actually a really important psychological element here. 50K is about $1 trillion asset. We tried it, start of 21, we got slammed down by 50%. We tried it again, no, not happening, back down to 15K. We then spent 8 months where every dip below that $1 trillion market cap, the market said, thank you very much, I'll take it. This was a tremendous zone of historical demand. I think the bears are going to have a lot harder time getting back through these levels. And really, what is this heat map telling us a story of? Where did people buy and still hold today? Right? It's showing you that conviction of people who really understand what Bitcoin is. They haven't been spooked by gold going up, by Bitcoin pulling down 40%, by, choose your weapon of various things that's happened this year. We have a ton more support on the road below us. And generally speaking, if you look at it from technical analysis or on-chain, we see that these supply gaps get filled very quickly, but it takes a lot of work to break the confidence of these historically heavily traded zones. We obviously have one above us. That's what we talked about before. That's the headwind that is above us. We've also got a ton of it below. Okay, last two charts. I mentioned the ETF cost basis earlier. That's this red curve. Why does this sell-off have our phones lighting up? Because we broke past the midpoint. This blue trace here is what's called the true market mean. And it is that middle level. It's the average cost basis for active investors, the perfect mean reversion model. In my view, this is why everyone's now in the acceptance phase of the bear. But we're also in the second half. We've entered the second half of that bear market. And in my view, the 2024 chop solidation zone is really where we are most likely to find that market arrest the overall fall. And we can actually assign probabilities to that. So this funky looking price model, it uses all sorts of mean reversion models. They're based on investor cost basis. We can look at it from the 200-day moving average. We can look at it from the 200-week moving average. You can look at it from the power law. You can choose whatever kind of mean reversion oscillator you want. And we can basically say, well, what are the odds in terms of historical trading action? If we're looking at these mean reversion anchors, it's like a center of gravity. Price wants to oscillate around it, and it always historically has. where are those mean reversion anchors, and how far can you stretch the slingshot until you're at 20%, 10%, 5% of all days being too stretched? Markets are mean reverting phenomena. Bitcoin even more so. Let me actually just show you price and the true market mean. So this is the average cost basis for investors on chain. We spend half of our time above it, half below, half above, half below, half above, half below. So it just has this beautiful mean reversion property to it. And I want to bring in these price models. This gives us a bit of an idea from a probabilistic standpoint. Where are things getting a bit silly to the downside? And when I say silly to the downside, we still have people going levered long in futures markets. They will start going levered short. All the people who have a price target of 60K, 50K will start revising it to 40K and 30K and 20K. You will see the most bearish sentiment. You'll see headlines saying that Sailor is soon to be liquidated. You'll see the most bearish stuff you've ever seen. And that will be when we're entering, I would say, somewhere in this cloud, which goes from about mid 60s down to low 50s. But the low 50s is like a 5% chance. If we look at where this happens, it's the final bottom wick. If you're away from the weekend, you miss it. And the odds of getting there is 5%. The chance of getting there is much slimmer. It is much more likely that we are within spitting distance of finding wherever that floor is. The top bound of this thing is about 20% odds. The middle of it's about 10%, and then down the bottom is 5%. And again, you can overlay any mean reversion model you want. The majority of the damage, in my view, the majority of the damage has been done. We're now just going through the process. And that's why I like to use this bison analogy. I think that is the most correct approach. We're in the eye of the storm. We've already run more than halfway through it. It's like that story of the dumb person who swims halfway from the island and then decides that they're tired and swims back. You're 2/3 of the way there. You turn around and swim. No, press on. You go to the other side of the scene because the odds, the lower this thing goes, we're now in the zone where the bears are going to get super emboldened, and the odds just flick more and more towards your favor.
That is all really fascinating. And I guess for me, some of the questions I've got are around the second or third last chart with the heat map on the purchases. Does that give you any indication of what to expect by way of severity and duration of the bear market?
Yeah, so the duration is a really hard component. I often think about markets a little bit like physics. You can tell the price but not the time, or you can tell the time but not the price. You'll never get both. It's one of those dynamics. Now, look, the thing about bear markets, we've seen bottom formations. Let me actually just pull this chart out a little bit more and just look at past price history. The 2015 bear, which is off chart here, that was a 12-month long base. It was about 5 months here in 2018. COVID was 1 day. And FTX was something along about 8 months. Now, in my opinion, bottom formation started in June. FTX was this weird, like, hyperextension type event. Now, I think the 2022 market is our closest relative. However, there are very important differences. I'm yet to be convinced as to what the story is that's going to be as cataclysmic as Genesis, Three Arrows, GBTC, FTX, Celsius, the whole industry. There was no industry afterwards. It was a forest fire of all forest fires. Now, the only thing that I can imagine coming in remotely close is strategy blowing up. And you can look at their balance sheet and just go, I mean, good luck with that. It's just not happening. So the actual elephant in the room is like, what creates, oh, by the way, rate hikes. Let's not forget that as well. Fastest rate hikes in history. Unless the world, like the actual macro world, just has a spasm and a half, possible, of course. Hard to construct a base case on something that says that the world implodes. Obviously, there's always these risks, but from my perspective, the duration, I don't think the depth and I don't think the duration are going to be the same magnitude as we've seen in previous bears. So my base case going forward, there's two things I think people should really be aware of. One, this bear is unlikely to look like previous bears. I think it's going to have different properties. A lot of people are going to stick to old formulas and they're going to get lost in the source because they're expecting the past to replicate what's going to move forward in the future. And I don't think that's how it's going to play out. And the other one is that all bear markets, and again, unless your decision tree is Bitcoin is dead, in which case turn off movie. Otherwise, at some point, we're going to put a base in And there's going to be a lot of people, the four cyclers in particular, people who think it's going to follow to a perfect calendar day, the 4-year cycle. I think they're going to get lost in the sauce. So be very flexible in your thinking moving forward. Don't anchor to past rules, because the world that Bitcoin grew up in is just not the world that we're currently in. We don't have we've got the infrastructure now of ETFs, options, financialization. It's just a different animal. You really can't compare it to previous cycles because the investor base is very, very different. And we've seen a tremendous rotation of capital. We saw that sell side from those hodlers. There's been just this like changing of the guard. A lot of people have worries about all that hodler selling. First of all, it happens every cycle. It's not abnormal. Second of all, if you've been hodling Bitcoin, and some of these guys have been hodling for 10 years, 5 years, 8 years, they've been in Bitcoin since extremely low prices. We saw one guy liquidate $9 billion. If he had liquidated $9 billion at any time in the past, the feds would have opened up his door and taken him out to a cage, because they're like, where'd you get this money? This is the first time ever that they've had the liquidity, the size, the scale, and the regulatory clarity to actually exit. It's like an IPO. Sometimes they may know the asset's going to go up, but like the delta between 9 billion and anything else is you've
irrelevant.
Won. It's rounding error, right? You've already won. So there's a lot of that going on. But as we saw before, we've just burnt through that all that headwind of sell side. It is very clear it's collapsing and falling off a cliff, and that's just removing a massive sell side headwind we've seen all last year.
It's interesting psychologically. I think what we've got to look forward to in light of this is the psychology behind selling, particularly for whales and OGs in the space. We're in a bear market. They're going to sit there for the next however long, and then when it comes back to previous all-time highs and the rest of it, they're familiar with it, but they've had to sit with it for the last 6 months, 8 months, 10 months, whatever it might be when we're finished with this bear market. And it's a very different psychology to having missed that opportunity. So can you talk to that in any respect?
Yeah, so I mean, we see this time and time again, and what I like about the on-chain side of things, this is not unique to Bitcoin. Every asset, everything I just showed you is there, we just can't see it. That's what's so amazing about this data, is it's just human beings making decisions. So what we always see is long-term holders start to sell as we come towards those peaks. And I put out a tweet after I sold my silver saying, gee, I really wish I had on-chain data for precious metals, because you know what I'd probably see right now? This was after we had that 38% sell-off in a day. We'd probably have a very, very top-heavy market, much like that bar chart we looked at earlier. We would have had a ton of long-term holders selling as we reached ridiculous heights on every metric known to man. And we would currently be seeing a bunch of people who bought recently, like the person who bought $220 coins because they were shiny, probably capitulating really, really nasty losses. So all the dynamics that we are seeing, in the process of seeing, and will continue to see for the Bitcoin market, every asset goes through this. It's not different to any other asset by that metric. So yeah, we'll see on long-term holders selling as we come towards the peak. But that's going to come after they've put a floor in. That's going to come after they've done the accumulation. And that's why I just come back to the very simple decision tree at the start. And I know there's a lot of folks who have watched gold go up and say that the thesis for Bitcoin is broken, or quantum's coming, so the thesis for Bitcoin is broken. Unless you can convince me that tree, I just think that gold is doing its own thing, and Bitcoin has a very credible case to be really the only other asset to do that long term. It's just young. And quantum's its own discussion, which I think is filled with all sorts of fugazi and question marks. But unless you go down that decision tree and say Bitcoin is dead, you go down the other one, you say, well, at some point it's going to find a flaw, and the history, statistics, everything says it always finds a flaw because it's a damn great asset. And once it does, all those momentum traders will come flying back in, and then it will start moving, and we'll look back at this period of time. We'll look back at this thing and go, gee, can you imagine everyone was bearish as sin when we were down 55% from the peak? Wow, how's that?
Unbelievable. If I can ask one question to finish off on, appreciate all that you do, and this information is just invaluable in light of where we are in the market. If you had to make a decision as to what will be the catalyst to drag us out of this bear market, what do you think it will be?
Time. It's just a process. We're in the thick of it. You just got to keep going through the other side of the storm. We don't know what the catalyst is going to be. It could be a Trump headline. It could be a geopolitical event. It could be look at around the world. There's any number of reasons why this can happen. There's a reason why I'm basically gold and Bitcoin as my primary assets, because I kind of look around the world and I'm like, what is the most risk-off thing to own? I know, something that I've got self-custody of, scarce, hard, and I put out a tweet just before we jumped on this call being like, I wanted to sell half a gold, it's a fictional story, I wanted to sell half a gold coin, but the guy told me that I had to go and get some silver instead, so I've got to go and buy this industrial metal, and then just to manage the silver-gold exchange rate so that I can like have a small amount of savings in it. And then, oh, wait a second, I clicked it in half, and oh, look, it's metal, it's gray on the inside. What happened to the rest of the gold coin? You just go through all these things like scarce, it's digital, it's divisible, and I have to post my gold coin, whereas I can just do a Bitcoin transaction. Is it a 10x better technology? Yes, it is. It is. And it just takes time. It takes time for people to work it out.
That's exactly how I feel about it. The investment in Bitcoin hasn't changed in any way, shape or form for me. I personally am getting a little bit of FOMO looking at these low levels around 72, 70, thinking, oh my goodness, what a buying opportunity. What can I sell next to buy more at these levels?
I can add to that. So as a professional analyst who every week we do 2 reports, through the grind that was 2025, I can tell you that there were weeks where I'm like, what am I going to write about? What on earth am I going to do to keep interest going? It's my job to make sure that Bitcoin is interesting. What am I going to do? This last 2 weeks, I got ideas coming out like crazy because I can see the fear. I can just see all of the things that we measure with on-chain data being like, I can see when everyone's having a great time. Everyone's in profit, everyone's loving life, and I can see those smart money selling. I'm like, this thing's going to crack at some point. And then we're now flipped over that other side where people are starting to accept the bear. The doom posts are coming out. They're starting to say it's going to 40K. Everyone's starting to have their opinion as to where it's going to go and bottom out. And I'm like, this is the movement that we want to see. Feeling fired up. So for us as a business, we're the Checkonchain treasury company. We have our DCA going from 95. We've doubled it now that we're below 80K. Below 70, we're now in like, you give me big slugs, you give me a big red candle, and we step in front of it. So double our DCA, and now looking for serious slugs below 70K. And very simple rule, we will keep doing that until we go back above that true market mean. If we're in the bottom half of this bear, no one's going to pick the bottom. And here's a pro tip. No one sends you a medal or a trophy or a medallion for buying the bottom week. There's no like prize or convention to celebrate the folks who buy the bottom. A lot of folks on Twitter love to tell you about it. But if you just buy the average of the bottom, you look back at it and go, what a great move. And we flick back above the true market mean, get into the second half of the movie, turn it off, let the market do its thing, and just ride the wave.
Great advice. Can't thank you and Alec enough for all you do. I think very privileged to be able to pick your brains and hear all this great information. And for any of our clients who are looking to subscribe, I can't recommend James's work highly enough. I personally have the highest subscription level available because this kind of information is absolutely priceless, particularly in moments like this. So, James, can I get you to tell us how our clients can take advantage of your service?
Sure. Yeah, you'll find us over at checkonchain.com. We've got 3 primary products. First, a charting website, which is all free. So every chart that we went through today and hundreds more, all available for free there. So you can kind of see what's going on. We do the paid newsletter, which twice a week, written and video and TLDR. Right, we've got a nice spread of people who just read TLDR. They watch, they read, they do both. And then Checkonchain Orange, which is the one you mentioned, is we do an additional, on top of the paid newsletter, we do a once a month conference call, and that's like a slide deck. It's where I really do some of my longest view thinking. Telegram group, like an exclusive group for those guys. So kind of a smaller knit set of folks, but that's more of an institutional high net worth grade product.
As a paying client, I can't endorse you enough. I think the work's absolutely fabulous, and for any client who has a serious investment in Bitcoin, I think that is absolutely great value for what you do, and eternally grateful for you being able to jump on a call along with Alec and get all this information out. So much appreciated. Thanks for all you do.
Thank you, Pete. Like the bison, get through to the other side of the storm. Sunny on the other side.
Fun times ahead. Thanks, mate.
Good on you. Thank you.